Alright, hello and welcome. What happens if you only invest in the most risky or most volatile stocks? Let's find out with Python. We need a couple of libraries: Y Finance to pull stock prices from the internet, pandas for data handling, NumPy for calculation purposes, and matplotlib to do some fancy visualizations. Then I'm going to define a function which is pulling stock price data, just calling that fetch data. Argument are a list of tickers and a starting point in time, so e.g. 2022 or whatever starting time horizon you're interested in. And then you just use Y Finance to download stock prices for the given tickers starting at the provided starting date. And for this use case we will need the adjusted close column, and with that we pull close prices for a list of stocks here. Then we calculate the returns on those, so just apply the PCG change function on the prices and drop NaN values, and then in the end we will return both the prices and also the calculated returns. So pretty straightforward how this function is working. So I'm just going to show you how this will work when you provide a list of tickers. So let's say we just pull Apple and Tesla here, starting let's say 2022, 1st of January. And this will give you a data frame like this, and then also returns. So you have prices and returns here. So if we assign that to, let's say data and returns, just for testing purposes, you have your prices and you also have your returns starting 2022 for Apple and Tesla. Next, we want to have a function to find the most volatile stocks. So this is going to be def get most volatile stocks. And this is taking a data frame of returns as an argument and also a top n value, and that is just the top 5, top 10, top 20 or whatever top volatility you're interested in. So I'm just setting that to top 20 by default, but you can play around with whatever you're interested in. Now inside here we have volatility. Use the provided returns data frame, calculate the standard deviation, and optionally you can annualize the volatility by simply multiplying with the square root of the number of trading days, usually 252 on average for 1 year. So this is just calculating the annualized volatility for a given return data frame, such as the one we generated above here. Then you calculate or define the most volatile stocks by just using volatility and then sort those values. Ascending equals false, so you want to have a descending order here. So you want to have the most volatile first, second volatile, third volatile, and so on. And then you just pull the head of that resulting series and you pull the top n values. So in this case, the top 20 values of that. Nothing more than that. In the end, you return the most volatile, and with that you can pass a return data frame to this function and you will get the top 20 most volatile stocks. So you could test that on our return data frame. So let's just pass R and take let's just keep the top 20 here, and you see you are getting those sorted here. In this case you only have 2 stocks here, and you see Tesla is more volatile than Apple, so it's being sorted Tesla first and then Apple. Super simple so far. So next one, we want to have a function simulating our portfolio returns, in specific the cumulative returns. So I'm just calling that simulate portfolio. You can also call that cumulative returns portfolio, whatever name you think makes the most sense. And this is taking the prices as an argument. So the price data frame containing all the prices for the picked stocks. And it's also taking your most volatile data frame. Volatile data frame. And how this is working, this is super straightforward. You just pick your only selected stocks, and your only selected stocks are just your top volatility stocks. So selected stocks are just your prices for only those which are most volatile. So as an example, you have 50 stocks, then you have 20 most volatile stocks, so you just filter the 50 stocks for the top 20 most volatile stocks. So you only consider the most volatile stocks here. Nothing more than that. Super simple, super straightforward. And then you wanna weight those stocks. So why do you need to do that? Because you wanna calculate the returns on that portfolio you filtered for the most volatile stocks. And therefore you have to assign a weight to every single of those components in your portfolio. Now we take the most straightforward way, that is simply we equal weight the stocks. So meaning, let's say you have a portfolio, super simple, out of Tesla and Apple. So you just assign 50% Tesla, 50% Apple. Or you add Microsoft and then you have 33% Tesla, 33% Microsoft, 33% Apple, and so on, right? So you just have equal weights, and you can calculate it pretty much straightforward by just using NP1s. Take the length of the selected stocks column. I'll show you what exactly I'm doing here in some seconds. So you just take the number of the selected stocks, and then you divide that by the length again of the selected stocks. So what exactly is this doing here? Super simple. So NP1s is just creating an array out of values, out of ones to be more specific. And if you provide numbers here, you will just get more dimensions here. Now, if you want to have equal weights, you just take the length of this array, so in this case 2, and divide that by 2 again. And with that you will get 50% here, 0.5 for a portfolio of 2 stocks. So if you have 3 here, you will get 33% each. So with that, it's flexible. It's just scalable for the weights for the assets, dependent on the number of assets. And the number of assets you're just getting by taking the length of the selected stocks column. Okay, right? So just as a reminder, on this one, we have length, the columns is 2 because you have Tesla and what was the other one again? And Apple. Alright, so super straightforward. In this case, you just take NP1s 2, and you're getting 50%, so it stays scalable for also an increasing number of assets. Super straightforward. So we have equal weights here. So next we're going to calculate portfolio returns, and this is simply selected stocks, then PCT change applied to get the return, dropping NaN values, and then super simple, you just take the calculated returns on that portfolio and take the dot product with the equal weights. So what you just do is you take the return of the assets and take the weight into account here. So you can do that by simply taking the selected stocks, calculate the returns, and then calculate the dot products with the equal weights. So you account for the weight and then the given return. With that, you have your portfolio return, and then you can just cumulative by taking 1 plus the portfolio returns and then take the cumulative product. So this is just accumulating returns. I've covered that in many of my previous videos. It's just accounting for the accumulation of portfolio returns or returns in general. So you just take the returns, take the cumulative product, and with that you calculate the returns over time. So in the end you just, let's call that cumulative returns actually, and return cumulative returns and portfolio returns. Alright, let's execute that. Next, I need a function to calculate the benchmark return. So in our case, we consider S&P 500 stocks. So our benchmark is the S&P 500. You can pull whatever benchmark you're interested in. So let's keep it more general. So dev fetch benchmark. This has the ticker of the benchmark and the starting point in time. Let's just pull benchmark as again just YF download on the provided benchmark starting at start. And again we only need the adjusted close column, and then we need the benchmark return, and that is simply percentage change on the benchmark, dropping in ants. Then just accumulate the returns again. So cumulative benchmark is 1 plus benchmark returns, cumulative products, and finally you just return the benchmark prices. So just let's return the cumulative benchmark first, and also the benchmark returns. With that we can plot both, so that you have the returns and also the cumulative benchmark returns. So just as an example, if you call this function on, let's say, the S&P 500, that is the Tinker symbol for that, and you start beginning of 2022, you get this. So you have the cumulative benchmark returns and also the daily benchmark returns here. So you could plot that. Let's plot that here. So with that you would get the S&P return, or the cumulative S&P return since 2022. Okay, so last but not least, a fancy plotting function, so stuff looks better. So plot performance, and we want to have the cumulative returns on the assets, so on the most volatile assets, and we also want to have the cumulative benchmark returns. So setting up a figure size, let's just say 10.6, just the size of the chart, then some plotting here. So first of all, cumulative returns, then give it a name, label is volatile portfolio, as the cumulative returns is containing the volatility filtered stocks. And then similar story for the benchmark returns, so just cumulative benchmark, label benchmark, so you have both cumulative returns you can plot against each other. Then you give it a title, that's optional. So volatile stocks versus benchmark, or whatever you want to name that chart. Give it a legend, and yeah, that's basically it. So PLT show. So we have a plotting function, so we can plot those volatile stocks against the benchmark. And finally, let's put that all together and take a look at the result. So I need a list of tickers, so I just pulled up some random tickers. These are all S&P 500 stocks, so you have to pass whatever stocks you're interested in. We just copy paste that from other screen here. Second, like this. So these are just some random tickers. So you see Apple, Microsoft, Amazon, Google, Tesla, Meta, Nvidia, Netflix, and so on. Some just randomly picked stocks here. So a list of tickers. So extend that or replace that, whatever tickers you're interested in. Also, you can just pass all S&P 500 tickers, also possible, and also a pretty interesting idea, to be honest. Then you define the benchmark ticker, which is just, as I said, GSPC for the S&P 500. You can also, if you're interested in other markets, so for instance, in my case would be DAX, you can compare that with local stocks and then compare it versus your regional or your country benchmark, also possible. And then we need a start date. So let's start in 2015 just to check a longer time period. So roughly 10 years. And then you start pulling stuff. So first of all, data and returns are just fetch data, the tickers, starting at the start date. So that's straightforward. You just get the prices for all those stocks. You see Apple and so on. Prices, and also for all those stocks, returns, daily returns here, as you see, so big data frame. Then you pass this to the most volatile function. So just calling most volatile and use get most volatile, providing the returns data frame as explained in the beginning. Get most volatile, some typo there, or named the function differently. Get most volatile stocks, yeah. So get most volatile stocks. So with that, you're getting the most volatile. Let's quickly take a look at that. So you see Tesla most volatile, Nvidia, Broadcom or whatever it's called, Intel, and so on. So you see these are the ranked stocks and also the top 20 stocks here. So you have your most volatile stocks calculated, and then we simulate the portfolio taking those stocks. So just taking cumulative returns and portfolio returns, and call our simulate function on the prices and the most volatile stocks. So you filter your portfolio for the most volatile stocks and then you accumulate those returns on the portfolio. So with that, you have your cumulative returns, your portfolio returns. So last step is just the benchmark. So cumulative benchmark and benchmark returns is simply fetch benchmark on benchmark ticker, which is the S&P 500, starting at the start date. Okay, so we got everything we need. So we can just plot those versus each other using our plot performance function and pass cumulative returns and the cumulative benchmark. So let's see what we are getting here. So we have this, let me zoom out a bit, this insane performance of the volatile portfolio versus the S&P benchmark. So you see a way more volatile chart here, but also a way outperforming portfolio here if you just take the top 20 volatile stocks. Yeah, so let's actually just print out some metrics besides that. So you can take the portfolio return and consider the mean return, annualize that. So you have the portfolio mean return, and also let's take a look at the portfolio standard deviation, also annualized. So print portfolio mean return and print portfolio risk. Then you have it lucidly showing up here. So print, everything print. So portfolio mean return, portfolio risk, and same story for the benchmark. So let's just copy paste here. Benchmark mean return, benchmark return mean, and benchmark return standard deviation. So, and benchmark risk. So let's see. You have portfolio mean return 31%, 0.28 risk, and you have a benchmark return of 0.12 versus a risk of 0.17, which is an interesting observation because you see that you're getting more than double of the return on average for not even double the amount of risk. So just from purely risk return perspective, taking the risk of the volatile stocks is worth it in that case. Alright. So overall, interesting observations. Play a bit around with that for yourself. Let me know your findings. And yeah, that's it for this video. Have fun with that, and I'm looking forward to seeing the upcoming videos. Cheers. Bye bye.